Also with us, Hugh Johnson. He's the founder, chairman, and chief investment officer of Hugh Johnson Advisors, which oversees nearly $2 billion in assets. Last month, Hugh indicated he was becoming somewhat less bullish on stocks. Where are you now, Hugh, when it comes to that?
Pretty much the same place. I've been bullish, but less bullish. Obviously, I think that we've gotten some fairly clear messages, strong messages from the financial markets that we might have problems ahead, problems for the economy and earnings. So every portfolio that we manage, we've taken some steps towards defense, basically reducing to some extent, not a lot, but reducing our exposure to equities, and then, of course, adding in the equity part of the portfolio some defense by buying some consumer staples. You can also buy healthcare. You can also buy utilities. We've chosen not to. We've added to some consumer staples, but still basically a bullish structure of the portfolio, but building in some defense just in case things really get worse.
Let me ask you, Hugh, as far as, I mean, I like to focus on equities, obviously, at the close of the equity markets, but it's an exciting story in bonds today, if only because we see yields so low and also supply getting smaller and smaller, the whole bond market shrinking. Where do you go?
You know, you don't have much choice, Adam. I mean, it's very clear that the yields are levels that are pretty unappetizing. Secondly, they're at levels which, you know, if you're a person of common sense, you have to believe, first of all, as we do believe, that the economy is going to start to expand. Inflation's going to get a little higher, not lower. I don't think the risk of deflation is well-founded. And so under those conditions, you would think that rates are going to move a little higher. So, yeah, you can buy bonds. You can, you know, hold your breath and buy them. You can get the return that's available. But quite frankly, you got to keep duration low. And the reason you got to keep duration low, because the odds are that in time, with the economy expanding, that rates are going to move a little bit higher. And it's going to be tough to make money in the bond market, believe me.
Andrew, I want to bring you back into this. You know, Hugh earlier was talking about building in some defense just in case. You know, we did see a huge sell-off in, not a huge, but a substantial sell-off in stocks last week. Do you think that's the right strategy based on what you're seeing in the marketplace at this point, build in some defense?
Well, the one thing I would say that I think has rallied pretty hard for the last couple of days is gold. I don't know where it closed today, but it's up like $12 this morning. It's up a lot on Friday. So it seems like people are, you know, trying to get out of equities and maybe into gold. I look at this trading range in the S&P. Obviously, I'm not a long-term player in the stock market. I'm a short-term player, you know, hour to hour, day to day, week to week. So right now I'm flat. You know, I think we're going to go lower. Monday's usually mutual fund Monday when stocks always rally. We didn't rally today, so I think we're going to go down this week.
Why don't you sell short then? Why don't you get short here, Andrew, if you think we have more downside coming up this week?
The problem is the volumes are so light that we could just rip either way, and there's not enough volume to support, you know, a rally or a sell-off. I'm looking at 1085 right now on the 50-day moving average in the S&P. You know, if it rips right through that, there's not that much volume, so it's a lot harder to get out of positions with the volume so light.
Hugh, does light volume affect your strategy at all? I mean, people say if you see light volume on the upside, obviously there's not a lot of conviction. I don't know if it's the same case on the way down, but what do you think about the volume, and what does it say to you?
Well, I think you're right. It shows not a lot of conviction or a high level of uncertainty, and I think that's the problem. And that's the question is are we going to have another recession, a renewed recession, double dip, whatever you want to call it, or are we going to miss a double dip, and is the economy going to continue to recover? Are we still in a bull market? That's really the issue, and there's so much uncertainty about the answer to that question that it shows up and everybody's sort of stepping back and waiting for the next set of economic numbers to try to give us the answer to that. Quite frankly, that's probably the right strategy. Let's wait for some economic numbers, particularly those that tell us where the economy is going, not where the economy has been, to give us a clue as to whether we're going to avoid that double dip. I think we're going to avoid the double dip, but I'd like to see it show up in some of the numbers, leading indicators for the economy that tell us where we're going.
All right, Hugh, thanks so much for joining us. Hugh Johnson there from Hugh Johnson Advisors. They manage a couple $2 billion in assets. And Andrew Keene, always a pleasure, independent trader from Chicago Board Options Exchange.